Okay, so you want to own a medieval village. You picture rolling green fields, a church bell ringing across the valley, peasants tipping their caps as you ride past on your way to collect a fat autumn harvest. Free labor, free rent, free everything, right up until you check the actual manor rolls. Here is a real number. At the manor of Cuxham in Oxfordshire in 1288, the Lord's Domain farm brought in about £20 of income for the year. The Lord's total obligations to the crown, to the church, and to his own household that same year came to nearly 18 of it. Read that again. £2 of margin on a working village. That is not a kingdom. That is a business running on a 2-week cushion. A medieval village was not a treasure chest with peasants attached. It was a fragile, overextended cash flow operation, and most of the men who owned one spent their whole lives one bad August away from losing it. Before you spend a single penny, you need to understand what you are actually buying, because it is not land. Land by itself, unpopulated and unworked, produced nothing. What you were buying was a manor, which meant a bundle of rights over people, not a plot of dirt. You owned the right to demand labor from your tenants for a set number of days a week. You owned the right to force them to grind their grain at your mill, bake their bread in your oven, and press their apples in your cider press, each for a fee. You owned the right to collect fines in your manor court, rent in cash or in kind from dozens of tenant holdings, and a cut of every inheritance, marriage, and land transfer in the village. Strip away all of that, and the fields were just fields. Nobody was coming to farm them for you out of loyalty. The entire structure of a medieval village was a machine for converting other people's labor into your income, and like any machine, it needed constant maintenance, constant fuel, and a workforce that could, and occasionally did, simply refuse to run it. So let's build one. The year is 1300. You have inherited, purchased, or been granted a modest English manor, roughly 500 to 600 acres of arable land split between your own domain farm and the tenant holdings around it, plus common pasture, woodland, and a scattering of cottages. First, the entry cost. Manors change hands constantly in this period through inheritance, marriage settlements, and outright sale, and surviving deeds give us a reasonable sense of price. A mid-sized manor with a working village attached could run anywhere from 100 to 300 pounds depending on soil quality, the number of tenants, and whether it came with valuable extras like a mill or a stretch of river with fishing rights. Call it 200 pounds for a solid, unremarkable manor. An unskilled laborer in 1300 earned roughly 2 pence a day. Multiply out the math, and 200 pounds represents about 24,000 laboring days, which is close to 90 years of a working man's wages. You are buying, in a single transaction, something close to a lifetime's income for an ordinary person, and you are buying it in one lump sum before you have collected a single rent payment. Before the running costs even start, there's a legal cost most people never think to price in. A manor did not pass to a new owner for free, even by inheritance. When a tenant-in-chief died and left a manor to an heir, the heir owed the crown a relief, a lump sum payment, often set at a full year's value of the estate, simply for the right to step into his own father's shoes. If the heir was a minor, the manor could be seized into wardship, meaning the crown or a favored courtier ran the estate and kept its income until the heir came of age, at which point the ward often received his inheritance back stripped of timber, livestock, and cash reserves by a guardian with no long-term stake in the place. Marrying an heiress who held a manor in her own right required yet another payment to the crown, this time for the right to marry her at all. None of this shows up in the romantic picture of inheriting your family's ancestral land. All of it shows up in the account rolls, usually as a debt carried over from the very first year of ownership. Now the running costs start, and the first one catches almost everyone off guard. You don't actually run the farm yourself. A lord with any pretensions to status did not walk behind a plow. He hired a bailiff or a reeve, a professional farm manager, who oversaw sowing, harvest, and the endless daily disputes of village life. Manorial account rolls from estates like Cuxham and Wistow show bailiffs earning somewhere between 10 and 13 shillings a year in cash, on top of grain allowances, and sometimes a cottage of their own. That sounds modest until you add the rest of the payroll beneath him. A dairymaid, a swineherd, a shepherd, an ox herd to manage the plow teams, a hayward to police the common fields and fine anyone who let their livestock stray, and at harvest time, dozens of additional day laborers brought in for a few frantic weeks. A single ordinary demesne farm in this period might carry 5 or 6 permanent famulae, as the records call them, each drawing a small cash wage plus a grain allowance called a liberatio of roughly a quarter of wheat or rye per week. Above the famulae sat the reeve, drawn from the villagers themselves. Rather than hired from outside, a tenant chosen or elected to enforce the Lord's will on his own neighbors, which was every bit as thankless as it sounds, and explains why manorial records are full of reeves fined for covering up their friends' shortfalls in rent. None of this labor was free. It was simply cheaper than hiring the same number of skilled tradesmen in a town, and cheap is not the same thing as costless. Here is something else nobody accounts for when they picture a medieval lord simply commanding labor free. Supervision itself was a cost. A villain owed you 2 or 3 days a week on your fields, called week work, plus extra boon work days at harvest and haymaking when every hand in the village was needed at once. But owed labor is not the same as motivated labor. Manorial court records are dense with entries for tenants who showed up late, worked slowly, sent a child instead of an able adult, or simply claimed illness in the exact days the Lord's hay needed turning before rain. A hayward had to be paid to police the common fields for stray animals and unauthorized grazing, and disputes over exactly whose sheep had wandered onto whose strip, or whether a tenant's boon work debt had actually been paid off in full, filled the manor court's docket every single session. None of this labor cost cash wages, and all of it cost time, patience, and a bailiff sharp enough to catch corner cutting before it cost you the harvest. Here is where the costs get genuinely interesting, because the biggest line item on most manorial count rolls was not wages at all. It was the plow team. A standard heavy plow in the English Midlands required a team of 6 or 8 oxen, and oxen are not tools you buy once. They are livestock that eat every single day, whether they are pulling a plow or standing idle in a snowstorm. A working ox in this period cost somewhere around 8 to 10 shillings to purchase and needed replacing every several years as animals died, went lame, or simply wore out from the work. Add the cost of iron shares and coulters that needed replacing after every heavy season, harness leather that rotted in wet years, and a smith's fee for every repair, and you begin to see why the Cuxham accounts show iron and plow gear as one of the largest recurring cash expenses on the entire farm, some years rivaling the wage bill out. The plow was the engine of the whole operation, and engines break. Now here is something almost nobody accounts for when they picture medieval farming: the seed corn. Before you can harvest a crop, you have to hold back roughly 1/4 to 1/3 of last year's yield, untouched, unsold, and unsent to any market, purely to plant next year's fields. On a manor sowing 200 acres of wheat, that could mean setting aside 50 to 70 quarters of grain that had real cash value the moment it left the ground, and which you were legally and practically obligated to lock away rather than sell. A single bad decision, selling too much grain in a hungry year when prices spiked, could leave a lord without enough seed to sow his own fields the following spring, forcing him to buy replacement seed at market rates from a neighbor, often at a steep premium, since everyone else in a bad year was short of exactly the same thing. Then there is the church, and the church did not wait to be asked. Every manor owed a tithe, 1/10 of all agricultural produce, paid directly to the parish, and ultimately upward through the ecclesiastical hierarchy. This was not a voluntary donation. Tithe barns still stand across the English countryside today, enormous structures built for the sole purpose of storing the church's cut of the harvest before your own grain had even been threshed. Add to that the various dues owed to the crown, scutage in place of military service, tallage levied on demesne lands at the king's discretion, and the occasional emergency tax to fund a war in France or Scotland that you had no say in and no interest in fighting. None of these obligations cared whether your harvest had failed. The tithe collector arrived on schedule regardless of the weather. Here is the counterintuitive part that genuinely surprises people. The single most valuable asset on most manors was not the plowland at all. It was the mill. Under legal principle, historians call the milling soak, tenants were forbidden from grinding their own grain at home under a handcorn, and were legally compelled to bring it to the lord's mill, where the miller extracted a processing fee, typically between 1/16 and 1/20 of the grain ground, sometimes higher in tightly controlled manors. A single well-sited water mill, especially one on a river that never froze or ran dry, could out-earn the entire arable farm around it. Domesday book itself records thousands of mills across England by 1086, and their value was already well understood 2 centuries before our village existed. The tenants had no real alternative. Grinding your own grain at home was, in many manners, an offense punishable in the lord's own court, with the confiscated quernstones sometimes built directly into the walls of the manor house as a visible warning. The mill did not care about the weather either. Rain that ruined a harvest often kept the mill wheel turning longer. Now let's talk about revenue, because this is where the actual business model of a village comes into focus, and it was far broader than simply selling grain. The core layer was rent, paid by free tenants and unfree villains alike, some in coin, some in kind, some in a mix of both. Above that sat labor services, the days each villain owed working your domain fields rather than his own, which saved you cash wages, but came at a real cost in supervision and frequently resentment and foot dragging that showed up as lower yields on the very days you were relying that labor most. Above that came the banal monopolies, the mill fee, the oven fee for anyone baking bread commercially, the fee for using your cider or wine press. Above that sat the manor court itself, which was not merely an administrative formality, but a genuine and reliable revenue stream. Every dispute over a stray pig, every fine for brewing bad ale, every Harriet payment when a tenant died and his family surrendered their best beast to keep the tenancy, every merchant fee paid for permission to marry a daughter outside the manor, all of it flowed into your accounts. And at the very top, for a lord fortunate enough to hold a manor near a market town or a river crossing, tolls on any trade passing through your territory, a source of income that had nothing whatsoever to do with the harvest, and therefore did not fail when the harvest did. There was one more revenue stream sitting above all of these, available only to a lucky minority of manors, and it dwarfed everything else when it applied. If your village sat near enough to a road or river crossing to justify it, you could petition the crown for a charter to hold a weekly market or an annual fair. A chartered market meant every stall, every trader passing through on market day, every sale of livestock or cloth or grain conducted within your jurisdiction owed you a toll. The crown granted hundreds of these charters across the 13th century alone, and a well-sited market town manor could out-earn an equivalent purely agricultural manor several times over from tolls alone without a single extra acre under the plow. The catch was that a market required traffic to justify its existence, and traffic required roads, bridges, and a reputation for safety that a lord had to actively maintain at his own expense, or watch merchants quietly reroute to a rival's market a few miles down the valley instead. The single catastrophic risk sat above all of this, and it arrived without warning in 1315. The Great Famine that struck northern Europe between 1315 and 1317 was triggered by years of relentless rain that rotted crops in the field and drowned livestock and flooded pastures. Grain yields across England are estimated to have collapsed by as much as half in the worst years. Prices for wheat, which might normally run around 5 to 6 shillings a quarter, spiked to 4 or 5 times that in the hungriest region. And here's the part that ruined lords who had run perfectly sound operations for a decade. Your fixed costs did not fall by half just because your harvest did. The tithe collector still came. The crown's tax demands, if anything, increased as the government scrambled for revenue amid a wider crisis. Your bailiff and your family still needed feeding, and feeding them from a shrunken harvest meant less grain left to sell, which meant less cash to cover rent shortfalls from tenants who were themselves starving and simply could not pay. Manorial accounts from these years, including the well-documented rolls from Bolton Priory in Yorkshire, show sheep flocks collapsing from disease brought on by the endless wet weather, in some cases losing the majority of the flock within a single accounting year. A well-run village, managed exactly according to best practice, could be gutted by weather patterns entirely outside anyone's control, and there was no insurance policy, no relief fund, and no appeal. There's a documented case that puts a human face on exactly this collapse. The account rolls of the manor of Halazaun, studied extensively by the historian Zivi Razi, record tenant after tenant during the famine years, falling behind on rent, surrendering their holdings back to the lord because they could no longer work them, and in a number of cases simply vanishing from the record entirely, presumed dead or fled. The court rolls from these years are thick with entries for empty tenements, land that had been productively worked for generations suddenly sitting fallow because there was no one left alive or present to farm it. A lord holding such a manor did not just lose a season's income, he lost tenants, and replacing a vanished tenant family with a new one willing to take on an unfamiliar possibility possibly famine-scarred holding at the old rent was not a quick fix. Some tenements in the hardest-hit villages stood empty for years, and the lord's own bailiff had to be paid from an already shrunken income simply to keep half-abandoned strips from reverting entirely to weeds and scrub before a new tenant could eventually be found. The famine did not strike every village with equal cruelty, and that unevenness is its own lesson. A manor with a diversified mix of wheat, oats, and legumes fared better than one committed heavily to a single grain, since the relentless rain of 1315 hit wheat and barley hardest, while hardier crops like oats and peas held up somewhat better. A manor with a mill on a river that kept running, but rather than one dependent solely on wind or a stream prone to flooding out its own wheel, kept at least one steady source of income through the worst years. The lords who survived the famine with their finances intact were rarely the ones who had simply farmed well in ordinary times. They were the ones who had, often by accident of geography rather than foresight, spread their risk across more than one kind of crop and more than one kind of income to begin with. So let's put real numbers on a year, because the shape of the risk only becomes obvious once you see it in a ledger. In a good year, a manor of this size might bring in roughly 20 pounds in rent and labor commutation, another 8 pounds from the domain farm's grain surplus sold at market, and 4 or 5 pounds from mill fees, oven fees, and court fines combined for a gross income near 33 pounds. Against that, tithes take roughly a tenth of the agricultural value. Call it 2 to 3 pounds. Wages for the bailiff and family run close to 6 pounds across the year. Plow gear, harness repair, and livestock replacement average another 3 pounds. Crown taxes and feudal dues in a normal year might claim 2 more. Total that up, and you're left with a surplus in the neighborhood of 17 to 18 pounds, a genuinely comfortable margin, enough to reinvest in better livestock or simply live well. An average year looks thinner. Rents run a little behind, as they always did, since some tenants were perpetually in arrears. Grain surplus for sale drops with an unremarkable but real dip in yield, and total income lands closer to 27 pounds. Costs barely move, since wages and tithes and plow repairs are not especially sensitive to a modest dip in the harvest, so they still claim close to 13 pounds. You are left with something like 14 pounds of surplus, comfortable but with less room to absorb a genuine shock. Then comes the famine year. Grain surplus for sale effectively disappears, since every spare quarter you have is needed to feed your own household and your own workers rather than sold at market. However tempting those famine prices might look on paper, rent income collapses as tenants, themselves starving, simply cannot pay, and manorial custom in a genuine crisis often force lords to grant at least partial remission rather than evict half the village and be left with fields nobody could work at all. Total income in a bad year might fall to something like 11 pounds. Against that, the tithe collector and the crown's tax demands barely soften. Your bailiff and family still need their grain allowance paid in full regardless of yield, and total fixed obligations still run close to 10 pounds. You are left with a single pound of surplus in the best case, and in the worst villages during 1315 to 1317, outright deficits that had to be covered by borrowing against future harvests that had not yet been proven to exist. So who actually got rich running a medieval village? Almost never the lord who simply farmed his domain well and collected his rents on schedule, however competent he might have been. The men who genuinely built fortunes were the ones who treated a single manor as the seed of a portfolio rather than the whole business. They accumulated multiple manors across different regions, so a bad harvest in one county could be offset by a good one in another. They controlled the mill and used the reliable, whether independent income from milling fees as working capital to lend to their own tenants and neighboring smallholders at interest during hard years, quietly acquiring land and loyalty at the same time. They married their daughters to families holding manors adjacent to their own, consolidating scattered holdings into a single, more efficiently managed block. And when the labor shortages that followed the Black Death in 1348 sent wages soaring and tenant bargaining power through the roof, the sharpest operators were the ones who had already begun converting labor services into cash rents years earlier, insulating themselves from a crisis that ruined lords still relying on villain labor that had simply stopped showing up. That shift shows up plainly in the surviving accounts of estates like Sedgeford in Norfolk, where lords who had already commuted much of their labor service into fixed cash rents before the plague weathered the post-1348 wage spike far better than neighbors still trying to compel unfree tenants who now had every incentive and often the leverage to walk to a nearby manor offering better term. The manor's true owner, in the fullest sense, was rarely the man whose name appeared on the deed. It was whichever creditor, church house, or neighboring lord held the mortgage, the tithe, or the unpaid rent arrears once a bad decade finally arrived. A medieval village looked from the outside like the most stable, permanent form of wealth a person could hold. Stone church, ancient fields, generations of the same families working the same strips of land. But underneath that permanence sat an operation with almost no slack in it, dependent on weather nobody controlled, labor that could vanish overnight to plague or famine, and fixed obligations to church and crown that never once adjusted downward to meet a bad year. The village was never the wealth. The margin between what it demanded and what it produced was, and in most years, for most lords, that margin was thinner than anyone standing in the manor house ever wanted to admit.